So Dale, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets? And what are some of the asset classes you focus on?
Okay, well, Michael, I've been around for a while. I'm still trying to figure out who I am. People could find me on Twitter at Forex Stop Hunter. I've been in the industry since the 70s. I remember when they were trading currencies on chalkboards at the Merc. So I've seen a lot. And what a great day for you and I to have a conversation, Michael. It's been years and timing. Talking about what's happening today. I know I follow you and you've been looking for a credit event. And if anyone wants to know what a credit event looks like, just pull up your TLT chart that's in free fall. And, it's all about confidence. And I guess we needed Fitch to light the fuse of a confidence crisis. I already think that we had a sovereign debt crisis underway. I trade a lot of currency, metals, commodities, and indices. And I think that we've reached an important inflection point, and equities are trying to fight their way back. But I think the nail in the coffin is going to be US dollar yen heading lower and sharply lower, and not because it's a strong currency, but has finally found a reason to be bought, along with what the BOJ is talking about, safe haven buying coming in a big way today. So we put in a lower high in the yen, and I think the yen has the yen itself quite a ways to rise, and the way we trade it in FX is US dollar yen. So trading at 42.30. 42 is important, Michael. And if we ever take out 138, all hell is going to break loose. So this puts pressure on the carry trade, makes it less efficient as you're paying more for both the rates and the appreciation of the yen.
Yeah. Okay. So on the credit event point, I just put a tweet out. It's like there's a clear shock that's happening in the Treasury side right now. It could be temporary, it could be capitulation, and there are delays, right, in terms of how that impacts risk assets.
Yeah, I mean, there's tipping points, but a lot of people have been trying to bottom pick the bonds, and some very smart people. Like the long side. I use RSI a lot in my work, and if any trader just pulls up a weekly on TLT and they look back to October, they'll see that the RSI was 20 before we stabilized and had that little bounce and just moved sideways for about 5 months. Markets rarely put in lows and highs when momentum is confirming the move. And on the weekly chart, that was a confirmed low that we had in the fall last year. Perhaps at new lows will diverge on the weekly, but I think 90 is well within sights. I'm surprised with what the yen is doing, that the bonds haven't even tried to recover much today. So new lows look like a magnet and destiny to me in TLT under 90.
And explain the interaction of the carry trade, the yen, and Treasury demand, at least for a moment in time.
Okay, well, carry trade is what, people go to low interest rate currency to fund the trades of assets that they want to buy. And we all know what they've been buying, right? A lot of tech, mainly the market. And there's been talk about the move broadening out. I heard a guy who, I talked to a lot of people. I've done well over 1,000 interviews on the other side of the mic, and people were saying it's broadening out, but rotation isn't necessarily bullish. And that's what's been happening here for the last few weeks, last month, broadening out things like Caterpillar and Deere, the old economy stocks starting to come back while tech has gotten heavy. And I think tech has, even though I'm kind of surprised they're up today, I guess people still think that Apple is a bond. That's the way they look at a lot of tech stocks. They're not a bond, and maybe we'll find out with earnings coming in later this afternoon. Now, I'm looking for a minimum of about 4,200. I doubt we could squeeze another high out of here. I mean, 4,600 is the Bears' last stand. Maybe we could go 4,620. But to me, it looks like a pretty negative reversal week, and that you have to sell rips in this market. And the battleground, to me, is going to be at the 4,200 level. That's where, when the market broke out, it became parabolic. That's when you had things like NVIDIA going parabolic to the upside. NVIDIA hasn't made a new high in a month. I'm actually bearish NVIDIA. I think there's a chance that we're going to do a gap fill in the coming weeks and months down around 320. So the dollar is the other important part of it. We had what most classic technicians would have called a major breakdown in the dollar. I think was July 17th, because I did an interview and said that I was bullish the dollar. That's when we took out par 90, a little double bottom, and it turned out to be a false breakout. I think there's plenty left in the dollar. I'd be selling rips in euro and especially cable, because I think the Dixie eventually can work its way up towards a 108 level. So buy breaks in the dollar, sell rips in S&P, and a lot of people probably disappointed that gold isn't performing. I still think there's a shot for 1,800 gold and $21 silver. That's when I'll be interested. Most likely not till the dollar peaks. So this is a classic example of a bit of a crisis developing. Also, Michael, are you surprised? Let me ask you. I know they weren't big banks, but both Heartland Bank and I believe PacWest failed over late last week, and no coverage, zero coverage. And I don't think that what's happening to the banking system is an accident. I actually think it's by design. And that Powell knew what all the banks were loaded up on before he began his tightening regime, knew they'd have duration problems. And, one of the most important financial or monetary stories since Bretton Woods is right in front of us, and it's a CBDC. And not many people talk about it. I don't know a lot about CBDCs and what it's going to be like, but I do know one thing, that to sell it to the American public, you can't do it just by saying, well, like during COVID, cash is dirty and it could spread disease, and they're going to need a confidence crisis and a lot of fear. So I think this banking crisis is by design for the Fed takeover of the banking system. And if you notice, CBDC is from the Fed. Prior to this, all of our currency came from the Treasury. So to me, this is a takeover, and you're going to have to have people be afraid, which they already are. And that's why withdrawals are continuing to happen at money market, at banks, and money market accounts are growing. People are buying bills, they're buying things locking in rates. So there's already the beginning of a confidence crisis in the banking system, and I expect it to continue. And I think that is another reason why the Fed will raise rates again.
I'll tell you something. When the regional bank, in quotes, crisis happened, I was very loud in saying, we're in a pre-election year. Pre-election years are historically the strongest of the cycle, largely because of stimulus. So how do you stimulate the economy when you have high inflation through a manufactured banking crisis, right? So, and that sounds conspiratorial, but it's funny. I had never. I'm not a big fan of kind of conspiracy theory. No. Right. But I do think there is a logic to what you're saying. Right. Because it's true. It's like, the Fed telegraphed it. freaking Jamie Dimon said a storm is coming. I mean, they have regulators and they have boots on the ground. They must have been calling up all the community banks saying, "What's going on with your duration mismatch potential?" You're correct. It seems almost, unless it's outright incompetence, which it could be, it seems almost impossible to believe. Right? It almost seems engineered. Yeah, it's an interesting thought process on that.
And Jamie brought up something else yesterday in an interview. He thought the downgrade by Fitch was ridiculous, but he brought up what the regulators are doing that could cause a problem, not just for regionals, but the big money center banks. I think it's cap requirements. I'm not an expert in that regulatory legalese, but he did bring it up that it could be troublesome what the regulators are doing and who the regulators work for, right? So, Jamie Dimon's also, he called out that there could be more banking problems, and he's pinning it on regulators. He also said that he would recommend that Powell rethink his models. So, smart guy. And so I expect these banking problems to continue to grow. There'll be lulls in the action. And I just think that this is a plan for us to get rid of paper completely. There's been a war on cash forever now. Now they have the instruments. They set up Fed Now. They're going to the CBDC unless the American public, and there are some politicians that are coming out against it. But, as Americans, we don't like a lot of friction. So it may just be that, we'll agree to it because we're not going to fight it. But I still think it's going to take a major confidence crisis in our financial system to pull it off.
All right, so let's think through sort of the movements in terms of the interaction of flight to safety currency. So you have a crisis, let's say it's akin to an 2008 banking crisis. Okay. So take us through how do currency markets anticipate or not anticipate, how the GFC unfolded? And is there any kind of parallel? Where I'm going with that is if you have sort of a confidence crisis, history would suggest the dollar still gets bid up, certainly against the euro. The yen would rally relative to the dollar. But then where does that money actually go? If it's like international money that's going to the U.S. because of the flight to safety trade, it wouldn't go into banks then.
It could go into cash. It could eventually flow into things like this is a time for gold. But I think that this risk-off event is going to affect everything, and that you really don't want to be long much except the dollar and eventually bonds and the dollar. So, I think the euro has a chance to trade back near parity. Cable trading at 127. I'd sell any rally 128, 128 and a half. I'm looking for about 116, 114, and still think there's downside in commodity currencies like the Aussie, 62, 62 and a half. So you just want to be long the dollar, probably just in 90-day T-bills. They don't have the TED spread anymore, but I bet it would be blowing out if they still had it. And wait for the dust to clear. I think it's going to take until the fall at least for things to get cheaper. So I think that this, this could be a great opportunity to get long some things after we have this liquidation and risk off. All risk assets are going to be under pressure. So people will be buying bonds, but you could just be in 90-day bills and not take any principal risk. I think that's where the money will go. It'll go into the dollar, buying T-bills.
What happens to X gold? What happens to commodities under that scenario? I mean, there's been a bit of a resurgence, right? The last few months, kind of cost push inflation picking up again.
Well, I think that if I'm right about the dollar going to 108, that we're going to see 1,800 gold. I think what we had happening in the energy market yesterday, we started to have a little bit of a sell-off. I don't think that this rally in crude has legs. So I think we could see crude again possibly trade back to new lows. And the one commodity sector that I'm pretty positive on that keeps giving some false signals are going to be the grains, because you can't print corn or wheat or beans. And I think that what Russia's doing may not be showing impact right now, but there are other factors. August is a month where the bean crop is made. So if we don't have good weather, we're going to have problems. We don't have a big carryover of grains going into next year. So we need a good crop. Australia has been fortunate with getting a lot of rain the last several years for their wheat crop. Perhaps that string breaks, but they're not just calling it El Nino, they're calling it Grande El Nino. So I do expect some weather events in the grain belt this summer, mainly not enough rain when they need it. So I think the grains are not economically sensitive like energy and copper. I know a lot of people, there are a lot of copper bulls out there because of, green energy and the demand for copper. But the copper, to me, looks like there's a possibility that during this sell-off that we have in the market, that if we take out 380, we could be looking at maybe 320 copper. So again, if you're a copper bull, you're a gold bull, the silver squeeze guys are going to have to wait for a while, I believe. And this could be, maybe the last bus stop. So I'm looking to get aggressive in miners, say around the 26 level in GDX. There's some juniors that I like. We're at 29, 28. So there still could be another 10% left in the miners to the downside or more, depending upon if I'm right about my gold count. But I think eventually silver miners are going to be, that's what I'm waiting for to buy, are the miners in the fall. Not here. Cash is king for a while. Mike, you've seen liquidity crises before. People will sell the kitchen sink to raise cash. So it's not a time to be long. It's a time to be flat and develop your list of what you think has great long-term potential after we get through this. I actually think the market will continue lower longer than things like gold and the dollar. I think this decline could last into the end of the year. And if we start taking out 4,200, next stop is 38. And under 38 is how you come up with about 3,000 S&Ps. That's my long-term objective.
I've been pretty consistent in this idea that, which I get a lot of hatred on, that we're still in a bear market, right? That I take issue with this idea that it's new bull market because, one, you only know that with hindsight, and you only know that if you've taken out the prior inflation-adjusted peak. So even if the S&P made a run for the nominal highs, it's nominal, right? You still need like another 15% with inflation since November 2021 to technically know that you've been in a bull market all along. You've been at this for a long time, Dale. There are always precursors, right? What I call the conditions, right, that favor something happening. And it seems like this is almost coming out of nowhere. Although, admittedly, it's not like the markets have utterly collapsed just yet, but clearly the collapse is happening in treasuries. If I'm right on the credit event, it should then, with a lag, finally filter through to credit spreads, which have been the stickiest, right, in terms of blowing out. That creates the VIX spike. That creates the capitulation that might end the bear market. And that also goes back to, that's how you break the October lows. You need to have an event to break the momentum, having been as strong. But if I'll turn the question back to you that you just asked me, right? So in prior sort of, high risk tail event type of setups, what's similar and what's not compared to history? Because this one is, arguably really interesting in that it's happening with the fastest rate hike cycle ever.
It definitely is. So I explain it as we've had a cyclical bull within the secular bear. And I still think that that's a possibility. But we got to about 78.6 back. Sometimes you have to set the table. I think VIX has bottomed. We may have pullbacks, but, I started looking at VIX at 13 and buying D's 25 calls. And I said, well, what's the VIX doing down here? It's priced for perfection, and things aren't perfect. So, there were some technical reasons to do it, but DSI at 9 and at 11. If the bulls are right about a melt up, and there are some guys that have been talking about it, not just recently, but, somewhat lower, new highs, that this 46.20 is the bear's last stand. We take that out, and then we're, probably headed towards 5,400, something like that. There's also a lot of geo stuff out there happening that the market has really completely ignored. The escalation is continuing in Ukraine. We're sending everything that they need. We're going to have an election year that's going to be completely. Rod Serling could not have written a narrative for what we're going to see next year.
I personally want to move out of the U.S. for a year. Right.
Okay. Well, where are you going to go?
I don't know. I feel like we got to start a campaign for those that just don't want to be a part of the shit show.
You know what? I've been thinking about it. I'm not sure where to go, but I'd rather be watching it on a flat screen than being in the middle of it in a high population density area. So let me know what you decide to do. But yeah, I think that next year is going to be very difficult. And if the market's a discounting mechanism, it's going to happen before next year. I think that we're down, most breaks, Mike, from the highs, the meat of the move happens within 7 or 8 weeks. So I think we're going to know a lot more by the fall equinox, late September. And that's about 7, 8 weeks from when this thing got started. So, I think that people should realize one thing. You don't have to trade. You don't always have to be a speculator. At times it's okay to be a spectator, especially if you're not a professional that really knows how to manage risk, and definitely not using leverage or reducing leverage greatly. And also knowing when you get into something, how much manage your risk, where are you wrong? Where are you wrong, and what are you looking for? If you can't answer those questions, why am I getting in? Where am I wrong? If I'm right, what am I looking for? You shouldn't even click your mouse, is my view. So, I think there's going to be some lessons learned here again, and 4,200 is going to be a very interesting battleground if we see it. So I would just, when in doubt, out for most people. I don't think they're going to miss much.
Matt from on the space is saying the place to go to is Costa Rica.
Okay,
which is not a bad. Yeah, I could do that.
Yeah, I have definitely never been there, but everyone I know loves it there. So, the summers might be a little rough temperature wise, but good idea, Matt. I give you a thumbs up on that.
Well, what do you think about I don't know if you track Bitcoin, but what do you think about Bitcoin? So it's funny because I think people are surprised by how loud now I'm starting to get on Bitcoin. Not because I've turned into a maxi, but throughout the last 2 years, I attacked repeatedly the store value narrative, the inflation hedge narrative, the idea that it should be seen as an investment with tail risk, not necessarily as something that's stable. So you have to weight it accordingly. And I think largely I've been right on that, especially as the kind of mania was taking place, a couple of years ago. But one of the things that you often hear is, Bitcoin is just a levered play on the NASDAQ. It's very, very correlated.
Well, that hasn't worked for months.
Right. That's my point. Right. So that's where I want to go. Right. So if the credit event thesis is correct, and again, it's conditions, it doesn't mean it's guaranteed to happen, but the odds favor, right? Do you think that Bitcoin diverges? I mean, I personally think that you could have, it doesn't have to be a situation where Bitcoin necessarily surges, but could just hold its ground while other risk assets break.
I think it's going to get caught up in the liquidation break. And, I can definitely see potential for 20,000 Bitcoin. And I wouldn't rule out a retest of the major area that it came out of, about 14, 15,000. I know some guys are looking for under 10, but that's something that I'm looking to buy after this risk event, credit event, whatever you want to label it, happens. That I'd be looking at Bitcoin. What I like about Bitcoin is look at what you just said. I want to get out of the U.S. for a year. There's nothing more portable. I don't know about price discovery. I've talked to some people that say fair value is 56, but the only price discovery I have is what are the technicals telling me? I've never bought Bitcoin, but I'm planning on buying it because of the portability feature and as a hedge against this CBDC, but lower.
Yeah, it's the when and when, right? When to buy.
Yeah, the timing. The art of trading is not the if; it's always the when. That's the art. So okay. I'd wait for at least 20,000.
Which goes back to what I say ad nauseum: path matters more than prediction.
And it's not only price too. Yeah, path is a great metaphor, because a week or so ago, I was looking to short the yen at, I thought we'd only get back to 40 and a half, 41. And the way it got there gave me pause because it was confirming the highs. But we've reached the last day or so up at this 4380 level, 4280 level. We did diverge. Okay. So I don't like to fight and top pick things unless I have momentum shifts. And we're finally getting one in the end. So this is, if you pull up your daily chart, you'll see a failing rally, an outside day to the downside. You're wrong over today's highs if you enter shorts. I could see us, if we take out 138, I think we're going to the low 130s. And I wouldn't be surprised if you pull up a weekly and we have equality from the last break when the BOJ actually had to intervene, right? Last fall. And that's also when the bonds bottomed. So, you could be looking for a bond bottom, but I look at the US dollar yen and I could make a case for 120 from 142.
Yeah, and as I understand it, the CFTC speculative short positioning is like stupid. I mean, the bets that there's a short squeeze potential at the market.
Yeah, everywhere. And look, the market's still bearish a dollar. And we're getting a little rally. I'm looking at my screen right now. I want to buy every dip in the dollar. We've had a nice run of about, 300 points, buy 50% pullback. 101 or so would be an ideal place to try it. And be patient. And or if you're aggressive, buy bearish ETFs. Okay, buy things that could take advantage of the downside. I actually like the SQQQ. I mean, it's not for the faint of heart. I like the VIX. So there are ways to play the downside, and I think that's where the money's going to be in the coming months, Michael. At least for 2 months. Should this high hold, we take out the recent high. I'm wrong, and that wouldn't be a news flash because I'm wrong a lot. And there's times I don't know. So when I don't know, I'm not afraid to tell people I don't know. When I was a younger guy, I felt like I had to know, even if I didn't. And I would, come up with something. But, there's wisdom in admitting you don't know, because I've learned that there could be a period where it's IDK. And if you're patient, the picture will clear up for you. So no one knows all the time. And we really never know, but we can see probabilities. And when we can't see, it could go either way. I don't know. The only thing I would do is put a volatility spread on by puts, by calls, because it's going to come out of here one way or the other. But, it's okay to not know, and everyone's wrong. The difference between pros and amateurs are pros know how to lose, so they have money left to be right with.
Yeah, and I tweet that out, post that out. This whole Twitter rebranding thing kills me on how to refer to things. But I always say, amateurs look to the right of the equal sign, pros look to the left. Right, sort of the conclusion versus what goes into it.
And look left. As a trader, a lot of people don't even know that simple thing about looking left in the market, because that's where the market's memory is. So if you're only looking right to where you think things can go and you're ignoring the left side of your chart, you're leaving a lot of gold on the table, a lot of priceless areas of former support or where a market broke out. And I mean, you could go back months and years and find these levels that the market will remember when it reaches it.
Speaking about looking left, which is basically going back in time, it's amazing to me how seemingly everyone forgot that there are lags on interest rate policy. It's like, and seemingly everyone forgot that the yield curve is still screaming recession, right? I mean, none of this matters until stock prices go down. When stock prices are going up, nobody cares about the stuff which never changed, right? And so it's because the narrative always follows that. Do you think that it's interesting, right? Because there's two disconnects, right? You've got the message of the stock market relative to the yield curve, then you've got the message of credit spreads relative to the yield curve, right? Would you say, let's play it out. Let's say something big happens, a tail event's out there. When would you know it's close to being over? You're never going to get the exact low. I mean, for me, to your point about it's actually where there could be a really good setup. To me, it's like, all right, if junk debt ends up yielding 15-20%. Right, on average. Yeah. Okay. You know what? That's a hell of an opportunity, because there's going to be inevitably an overreaction if there's an event around default risk. So you'll get the less liquid, high yield junk debt issuances really getting slammed, which becomes a really good opportunity. You can get some good income, right? Assuming that things don't go bust all at once, obviously. But what would be some of the markers for the risk being not as elevated or at least over?
Well, first of all, I think that TLT is going to make new lows. I think there could be a flight to quality rally in bonds and notes, but I'm looking for 4.9 10-year by the end of the year. So, I think that rates could stay high. And a lot of people don't understand that, it's not because of inflation or growth. The problem is supply. Okay, so you could have a liquidity crisis and rates go up because there's not enough demand. The Fed's going to have, I don't know who else is going to buy this offering besides the Fed. So they're going to have to come in and do something. But, the market's still at 4,500. They're not going to do anything until we're, 20, 30% lower. And they're going to have to do something because interest costs on the debt is going to, it can't be handled. And, kind of the tip off was, and I asked a lot of people, you're a great guy to ask. So TLT, when you line up the charts between TLT and say LQD and HYG, junk had the strongest pattern, followed by corporate, then followed by treasuries, which is the opposite of what it used to be for most of my career.
Which, by the way, can I just say real quick?
Go ahead.
You're describing perfectly my hell. And people will say, that's because it's the end of the 40-year bond bull market. I don't buy that because I can show plenty of times historically prior to the 80s where you still had that flight to safety trade. But I guess the question is, when does that really kick in? Now, you saw that momentarily in March because if you remember, right, the regional banks happened and then, TLT as a proxy, right, went up in price as markets were going down. You had a little glimpse of that flight to safety trade. I guess the question is what's happening here in treasuries. Is it first and then stocks are after, right? Is it a lagged response by equities? Because, it's almost like a Wile E. Coyote. The stock market's not believing what's happening around it. It's not getting the memo that we might be in a credit event now.
Yeah. Well, I just found it ironic and kind of confirms the sovereign part of the debt crisis. That's not only happening here, it started with the gilts in the UK. So it's a global sovereign debt problem. And it's so ironic that people would buy junk believing that they have a better chance of being repaid than buying treasuries.
Well, which is why this whole thing is so insane to me. Even like you alluded to before, the idea that Apple is safe bond. It's like
it's a bond now.
The United States government owns us through taxation. So if it's like Jamie Dimon said, I think yesterday, and I made this point, it's also the same reason why in 2011 on the downgrade yields actually fell after S&P downgraded. If the U.S. government's credit quality is shit, everything else has to be shit because they own us. That just means they're going to tax us more, including Apple. They'll find a way.
Yeah, unless China does something before that.
Right.
So I don't know why we keep poking the tiger in the eye. But that's another story. They're launching this new currency late August. I don't know much about it, but, they're trying to be king. So we'll see what happens with that. I remember talking to a guy, Martin Armstrong. He's not really that public anymore, but
I've been trying to get him on a.
All right, he's great. His pie model, but he talked about sovereign bond crisis. Back then when Greece was having problems, the European crisis, and his models say it starts in Europe first, which the gilts did, and then it travels to Asia. And maybe that's what's going to happen with the yen and JGBs. And then finally washes upon the shores of the U.S. because we're still, I hate the expression, but I'll use it, the cleanest dirty shirt out there. So I don't know when I'm looking at LQD right now, and it looks like it could wash out to new lows. HYG, I don't know if it will. It's so far off the COVID lows compared to everything else. And, we had a credit event in 2021, Michael. I mean, look at where TLT was. That was the worst bear market in bonds I've seen in my whole career. Wasn't that a credit event?
Well, by the way, I had put out that stat before. It's like if you were to take the drawdown in long duration treasuries, the drawdown started actually in like July 2020. Right, it was like as we were kind of getting off of the lockdowns. So if you take the magnitude of the drawdown in duration treasuries, it would rank it among the fifth largest declines for the stock market. In history, going back to the Great Depression. So I reference that from just for perspective, right? That it's like I don't know if people really understand the kind of shock that happens, right? Especially last year. And understand, let alone the shock, but how there are delays in terms of when the shock hits everything else.
Yeah, and it's not just regional banks. How about pension funds that had to, because of suppression, had to go out and take risks that they normally wouldn't, and they're still not. I think CalPERS still didn't get to their mark of 8%, and who knows what they own. And, there could be, our guarantees for pensions. I think President Biden sent made a payment to help the Teamsters about 6 months ago with their pension. So we also have a pension crisis. And, there's one scene, I actually didn't think that I was, just to be contrarian, I didn't think they'd come up with a debt deal. But, there's that one scene that keeps resonating, and I keep seeing it in my head, where President Biden made the address from the Oval Office, his first one, and underneath him it said financial crisis averted. And it should have been
like mission accomplished. So Bush.
Yeah, exactly. It should have been financial crisis delayed. So, we're in it. And, you could call it a crisis. You could call it an opportunity. There are a lot of things that haven't fallen apart yet. So, there's plenty of trading opportunities. But I think, this action in bonds, and they're not coming back because the market's coming back. So I'm looking for TLT to make a new low, Michael. We're only 5 handles away. So, then we might have some divergences. But this, to me, in Elliott terms, was a 4, right? Which means that we're in a 5. And, maybe it's a triangle, which means this next thrust down is terminal. So I think that there will be a bottom in these bonds, but at new lows. And if you pull up your weekly TLT charts, everyone who's listens to us now or later, just put a simple 14-day RSI up on a weekly, and you'll see it's at 20. I don't think we're going to get to those momentum levels. I mean, we could be there by Monday, Tuesday at new lows, the way they're trading now.
In 2020, I was on fire with a lot of the kind of broad analysis. I said, I think we're going to crash late February. I said first week of March 2020, I think toward the end of March would mark the low based on the signals I'm known for. And then, here comes the COVID-19 bubble. That's how I framed it back then. But I had this idea in 2020, which obviously didn't play out in the way that I thought, that bonds would crash first, then stocks. Arguably, you didn't have a crash in the sense of, like a 1 or 2 day type of event, right? But I do wonder now if that scenario still is likely, and maybe even starting now. I mean, you have this real collapse suddenly in treasuries, and then again with the delay, stocks respond. You were, I'm assuming, trading throughout 87. As I recall, yields were, the 10-year was rising.
And the dollar was falling. We had disintermediation for a while.
Right. And then as I recall, it was maybe 2 to 3 weeks before the 87 crash itself, yields were dropping. So suddenly the 10-year started almost sensing something was coming. So I don't know. I just wonder if that, similar type of setup.
That could be it.
Right.
That could be it. We'll see it. I think we'll see it first in the 10-year. And, like I said, we could be at new lows in TLT by early next week, and maybe that's going to be it. Maybe the market holds together through earnings. Maybe Apple gives the street something to cheer about, or maybe earnings are okay. But, the market can't, it's interesting in 87 also, the dollar was falling. Okay, that was a difference. The dollar was falling. It's a lot different than 87. We didn't have this kind of leverage. We didn't have this. We weren't in a rising. Rates were going up, but the dollar was falling. So now the dollar's going up. I think that only exacerbates like a downward little whiff of deflation spike. So you never know. It's kind of like you could have a snowstorm all over the mountains, and it looks like there should be an avalanche, and it's at last snowflake. That's the tipping point.
Right.
And so I think that, just looking at what I'm seeing, dollar rallying, bonds, capitulation low happening here, the first signs of some weakness in tech, which led the way up. And if it's going to lead the way up, I think it leads the way down. So there are signs.
Well, it almost has to, right? So I've made that point before. So in behavioral finance, there's this concept called the disposition effect. So you look at when faced with a margin call or when faced with uncertainty, the first thing that people sell is not their losers, because they want to get back to break even relative to the price they paid. They want to sell their winners.
I do it.
Right, everyone. It's a big right because hey, I make gains. I might as well take some off the profit, to cover my losses. So my point is, okay, so you look at a year like this year, it's very clear where the gains are. The Magnificent Seven, which were the leaders, suddenly become the source of liquidity from
like the Nifty 50.
Right. Which I put that tweet out and like some idiotic trolls were saying, "Oh, look at this guy talking about how Nvidia can bring down the whole stock market." No, that's actually exactly what I'm talking about. It's the disposition effects, the behavioral response, right, when faced with uncertainty to get out of your winners, and things like Nvidia and the other Magnificent Seven. I mean, those are the target.
Well, the gap is filled in Nvidia down around 315, and the 200-day moving average is coming in at about 270. And if we get through 4.25, that move is underway. So we've had a couple of, let me just, I'll put this out here. So NVIDIA put in its high on the 14th of July, okay? And the market's made successive higher highs, the S&Ps, until this week. And NVIDIA has made 2 more attempts to make a new high unsuccessfully. And even if it does, the momentum divergence will be so negative, I would sell more. So, I think that people are going to see what can happen. Apple, NVIDIA, AMD doesn't look so great to me, back under 110. You could see 80. Amazon, I think they have earnings tonight. That looks like it's exhausted too. So, maybe we'll be at Tuesday we'll be at 4,600, but I doubt it. So I think this is a rip to sell. Looking at the S&Ps, if I go intraday, I would just I would draw some fibs. 4480 is really needed to be taken out to confirm this, but I'd be a seller back at around 45.5, 4560 with stops over the high of the move. 4540, 4560 if we got there. I think 40 would be more or less the number. 40, 60 stops over the high of the move, which was 4610. So that's how I'd approach the market. And maybe we get, 2-3 day bounce while bonds are cratering here. And then the worm turns next week, Michael. But the yen is convincing me because I thought that as long as the yen, US dollar yen held together, the market might have a chance. But the signal I'm getting here, sell rips to 143 in US dollar yen if you get it. And the dollar signal, I think we're not going to make a new low in the dollar. So there might be, sometimes you could already have made a low in the dollar, high in the yen, but then you get the correction of that first wave up in the dollar and the market takes advantage of that. That may be what we're seeing right now, is that the dollar weakens because it's been a pretty good move over 2.5 weeks. Dollar weakens for a few days and the market takes some confidence in that, but the dollar has bottomed. And I'm not a dollar bull. I'm not a milkshake guy. I'm not looking for 130, 140. I think the dollar's will be the sacrificial lamb to make the market recover. But that's going to be from the Dixie, 108 to 110 level. Then I think we could be talking about sub 90 in the Dixie. So this is like an event to me. It's almost like a tornado. Okay, tornado blowing in, and there'll be some time to repair and rebuild. But I think the majority of the high winds are the next 2 months.
Dale, for those who are listening on Twitter, on the space, on X, whatever you want to call the app now, where can people find some more of your thoughts and content and analysis?
Okay, well, I host a free webinar every day. In fact, Michael, you and I will be talking tomorrow morning, to see what the NFP, I forgot we have the NFP tomorrow, but it's at Forex Analytics. The show is called FACE. It's a Forex Analytics community experience, and that's from 8:30 a.m. to 9:30 a.m. Eastern time. And my commentary and technical work is on TradeGateHub.com, where I'm head of trader development there. So you could catch my stuff there. And really enjoyed talking to you on such an important time in history that we have here, Michael. And let's make hay.
I appreciate it, Dale. Everybody, thanks for joining. I'll do this. I'll have this as an edited podcast soon enough. Well-timed conversation with a real pro in the industry. So I will try to retweet one of Dale's more recent tweets. So you can at least follow him on the platform, and hopefully I'll see you all later. Thank you, Dale. Appreciate it.
Hey, I enjoyed it, Michael. Great to talk to you again. I learned from you today as well. Thank you.